Ever wondered what cryptocurrency is all about? Or how digital currencies like Bitcoin and Ethereum operate behind the scenes? It might seem complex, but we're here to break it down. Welcome to WhiteboardDoodles, the channel where we simplify tech-related concepts using whiteboard animations. Today, we're diving into the world of cryptocurrency, exploring how it works, why it's gaining popularity, and what it means for the future of money. Let's get started. First, let's take a brief look at what cryptocurrency is. Cryptocurrency is a type of digital currency designed to function as a medium of exchange over the internet. Unlike traditional currencies issued by governments, cryptocurrencies are decentralized, meaning they are not controlled by any central authority like a bank. Instead, they exist only in digital form and rely on cryptographic techniques to ensure secure and anonymous transactions. Cryptocurrencies like Bitcoin, Ethereum, and many others allow people to send and receive money online, offering a global and efficient alternative to physical cash or traditional financial systems. They have gained popularity for their potential to revolutionize how we think about money and financial transactions. Now that we understand what cryptocurrency is, let's explore how it works. Cryptocurrency works through a technology called blockchain, which acts like a digital record book for all transactions made with a particular cryptocurrency. Instead of being stored in one central place, this record is shared across many computers, making it secure and transparent. Each transaction is grouped with others into a block, and these blocks are linked together in a chain, forming a complete history of all transactions. This process uses special codes to keep the information safe and prevent changes to the transaction data. To use cryptocurrency, people have digital wallets that store private keys, allowing them to send and receive money securely. Miners, who are individuals using powerful computers, validate and confirm these transactions, helping to maintain the integrity of the blockchain. This decentralized setup not only improves security but also ensures that anyone can view the transaction history without revealing the identities of the people involved. For a deeper dive into the cryptographic techniques that keep these transactions secure, like encryption, keys, and digital signatures, check out our separate video on cryptography basics in the video description. Now let's take a closer look at blockchains. A blockchain is a decentralized digital ledger that stores transactions across a network of computers or nodes without relying on a central authority. This structure allows the network to collectively verify and record transactions. Each verified transaction is grouped into a block, which is then added to a chain of previous blocks, creating a permanent, ordered record. What makes blockchain unique is its transparency. Anyone on the network can view the full transaction history, promoting openness and trust. Another feature is immutability, which means that once data is added to the blockchain, it cannot be altered without the approval of the majority of nodes. Beyond its use in cryptocurrencies, blockchain has many other applications, such as smart contracts, supply chain tracking, and secure voting systems, where decentralization and security are key. Next, let's discuss cryptocurrency wallets. A cryptocurrency wallet is a digital tool that allows users to store, send, and receive cryptocurrencies. Unlike a traditional wallet that holds physical money, a cryptocurrency wallet stores the private and public keys that are used to access your digital assets on the blockchain. The private key is a secure password that gives the user control over their funds and the ability to sign transactions, while the public key serves as an address that others use to send cryptocurrency to the wallet. There are several types of wallets, including software wallets, which are apps or programs on computers and smartphones, and hardware wallets, which are physical devices designed to keep keys offline for enhanced security. Another option is a paper wallet, which involves printing your keys onto paper for cold storage. For convenience, many users also use web wallets, hosted by online services. Each type comes with its own balance of convenience and security. Software and web wallets are easier to use but more vulnerable to hacks, while hardware and paper wallets offer greater security but are less accessible. Protecting the private key is critical, as losing it means losing access to your funds permanently. Additionally, wallets can often store multiple types of cryptocurrencies, making them versatile tools for managing various assets. Now let's explore how cryptocurrency transactions work. A cryptocurrency transaction is the process of transferring digital assets from one wallet to another over a blockchain network. When a transaction is initiated, the sender uses their private key to sign the transaction, ensuring that only they can authorize the transfer. The transaction is then broadcast to the network, where it is verified by multiple computers, known as nodes or miners, depending on the blockchain's consensus mechanism. Once verified, the transaction is grouped with others into a block, which is added to the blockchain. Unlike traditional transactions that rely on banks or intermediaries, cryptocurrency transactions occur directly between users, making them peer-to-peer. This allows for faster transfers, especially across borders, and often with lower fees. The entire process is secured using cryptography, ensuring the transaction data is protected and cannot be altered once added to the blockchain. Now, let's briefly take a look at some popular cryptocurrencies. There are thousands of cryptocurrencies in existence today, but some have gained significant popularity and market value. Bitcoin, created in 2009, is the first and most well-known cryptocurrency, often referred to as digital gold due to its limited supply and status as a store of value. Ethereum, launched in 2015, is notable for its smart contract functionality, allowing developers to build decentralized applications or dApps on its blockchain. Other popular cryptocurrencies include Binance Coin, which is used for trading fees on the Binance Exchange, and Cardano, known for its focus on scalability and sustainability through a proof-of-stake consensus mechanism. Solana has also gained attention for its high transaction speeds and low fees, making it a preferred choice for developers. Each of these cryptocurrencies serves unique purposes and functions within the broader cryptocurrency ecosystem, contributing to the diversity and innovation of digital currencies. Now let's analyze the differences between cryptocurrency and traditional money. Cryptocurrency and traditional money, or fiat currency, differ in several key ways. Traditional money, like dollars or euros, is issued and regulated by governments and central banks, and its value is often influenced by factors such as inflation, interest rates, and government policies. In contrast, cryptocurrencies are decentralized, meaning they are not controlled by any government or institution. They operate on blockchain technology, which allows for peer-to-peer transactions without intermediaries like banks. This decentralized nature often results in lower transaction fees and faster cross-border transfers compared to traditional banking systems. While traditional money has a physical form, cryptocurrencies exist purely in digital form. Additionally, the supply of many cryptocurrencies, like Bitcoin, is capped, whereas fiat currency can be printed as needed, leading to potential inflation. Despite these differences, both forms of money serve as a medium of exchange, but cryptocurrencies offer a global, digital alternative that challenges the traditional financial system. Next, let's take a look at what mining is. Mining is the process used in many cryptocurrencies, like Bitcoin, to validate transactions and secure the network. It involves solving complex mathematical puzzles using computer power, which helps to verify and add new transactions to the blockchain. Miners compete to solve these puzzles, and the first to solve one gets to add a block of transactions to the blockchain and is rewarded with newly minted cryptocurrency, known as a block reward. This process not only helps secure the network, but also creates new coins in a decentralized manner. However, mining requires significant computational resources and energy, leading to concerns about its environmental impact. Some cryptocurrencies use alternative methods, like proof of stake, which are more energy efficient. Now, let's explore the risks and challenges associated with cryptocurrencies. While cryptocurrencies offer many advantages, they also come with significant risks and challenges. One of the main concerns is volatility. Cryptocurrency prices can fluctuate dramatically, making them unpredictable as a store of value or investment. Another risk is the lack of regulation, which can expose users to scams, fraud, or market manipulation. Additionally, cryptocurrencies are often targeted by hackers due to the irreversible nature of transactions. If someone gains access to your wallet, it's nearly impossible to recover lost funds. The environmental impact of energy-intensive mining processes, particularly for coins like Bitcoin, is also a growing concern. Furthermore, cryptocurrencies can be used for illicit activities due to their relative anonymity, raising regulatory and ethical issues. Lastly, there are still significant adoption challenges, as many people and businesses are unfamiliar with or skeptical of using cryptocurrencies in everyday transactions. Now let's look ahead to the future of cryptocurrency. The future of cryptocurrency holds both exciting potential and significant uncertainties. As more individuals, businesses, and even governments explore digital currencies, there is growing interest in how cryptocurrencies could reshape global finance. Innovations like decentralized finance and smart contracts are expanding the functionality of blockchain technology, offering new possibilities beyond simple transactions. Some countries are even considering or implementing central bank digital currencies, which could coexist with or compete against decentralized cryptocurrencies. However, the future also brings challenges, such as regulatory hurdles and addressing concerns over environmental impact and security. Mass adoption may depend on solving these issues while maintaining the core benefits of privacy, decentralization, and financial accessibility. As technology and regulations evolve, cryptocurrencies could become a more integral part of the financial landscape or face significant pushback from traditional systems. In conclusion, cryptocurrencies represent a transformative shift in the way we perceive and engage with money. As digital currencies gain traction, they offer promising benefits such as enhanced privacy, decentralization, and financial accessibility. However, the journey toward widespread adoption is not without its challenges, including regulatory hurdles and concerns over security and environmental impact. Understanding the fundamentals of cryptocurrencies, their underlying technologies, like blockchain and the various types available, can empower individuals to navigate this evolving landscape. As technology and regulations continue to develop, the future of cryptocurrency holds the potential for significant integration into the global financial system, presenting both opportunities and uncertainties. This concludes our exploration of the basics of cryptocurrency. If you enjoyed it, consider subscribing to our channel and liking the video. Feel free to also check out our other videos on related topics. Thank you for watching.